Hello and welcome to Sprott Radio. I'm Ed Coyne, Senior Managing Partner at Sprott. With me today, I have one of our returning guests and one of Sprott's very own, Justin Tolman, Senior Portfolio Manager and Economic Geologist. Justin, as always, thank you for joining me on Sprott Radio.
You're most welcome, Ed. It's my pleasure.
Well, Justin, I want to talk specifically about what we're seeing in the metals markets today, beyond just precious metals, and really get into all metals, critical materials, steel, you name it, all the things we need in the world today and why we need them. And I also want to talk today a bit about different ways to go about investing in that space, whether it's a passive strategy, an active strategy, why you think one over another makes more sense, and just really unpack this opportunity because a lot of things seem to be happening right now. Let's just start with the base case on why the metals market in general is growing and what are some of the metals out there that are gaining your attention right now?
The big macro drivers in the metals and mining space, as I see it, two things. You've got energy growth and you've got energy and mineral security. And this drives a lot of our investment theses right now here at Sprott. You know, there's some short-term perturbations going on in the economy, whether it's tariffs or changing trade policy or other things that lead to increased uncertainty. And, you know, that can cause investment paralysis. But if you step back and you look at the long-term drivers for commodities, it starts with energy growth. By 2050, we're going to have close to 10 billion people on this planet. And that means huge investments in infrastructure, homes, schools, hospitals, highways. They're all hugely resource intensive. More than half of those people are going to be in developing economies with, long growth cycles, young populations, rising incomes. And they're working to bring their lifestyle closer to that of developed countries. And that means metals and that means energy. That means power generation, power transmission. There is no such thing as a country with a low energy consumption and a high income per capita. Those things on a log scale graph at 1-to-1. So if you're a developing economy, you just don't need a little bit more metals. You need an order of magnitude more to lift yourself up to developed economies. You put those two things together, and that means more people in cities. We're going to add 2.5 billion people to the world's cities. And guess what? Cities use huge amounts of steel, copper, and they need way more power than other areas. Over in the developed world, we've seen a big push with the growth of technology infrastructure, AI, telecommunications, data centers, and the amount of energy going into those. The growth rates are eye-watering. It's up 60% in 3 years. And 3 years ago, AI wasn't even in the vernacular. You can check the frequency in Google searches, but that's set to double in the next 5 years. And frankly, our current infrastructure isn't set up for that demand. And it's got to come from everywhere. And a lot of that is going to be what we call non-traditional energy sources, solar, nuclear. We need all of it. It's, not a case of one necessarily, replacing the other. The drivers I'm talking about, at least in the medium term, it's going to have to come from everywhere, and it's going to have to come sooner rather than later. The flip side of this is the energy and mineral security discussion. And that's being moved right into the forefront now. Energy security is power. If you have growth ambitions and you don't have control over your minerals, materials, and energy, you're hugely at risk. You stick out like a sore thumb. So you see governments everywhere making these lists of critical materials.
One of the things I think that's happened is in the last, say, 5 years or so, the first trend, the first group of investors waking up to this reality we're just looking at basic indexes, ETFs, just ways to get exposure to it. As it's evolved, there's become this, maybe not a debate, but there's been a line in the sand of, do you just want exposure to it, or do you want a more active, engaged exposure to it? Can we talk about that? Because this space is unique in that it's not as liquid as some other spaces. You really need to have a educated background in the space. I mean, I'm talking today to you. You're an economic geologist. You're also a portfolio manager. You know this space. You've lived and breathed this space for a very long time. So, talk about the value of approaching it as an active portfolio manager versus simply just getting exposure to the space. What are the pros and cons? How are you thinking about it? What would you tell an investor?
Obviously, I fall down on the side of being proactive management, not least of which in that I've got a vested interest in it, but it's served me very well over the last few decades in my tenure here at Sprott. But at active management, what we're really trying to do is, you know, it's one thing to say, I want exposure, and you can generate a set of formulas and gain exposure. What we're trying to do is curate asymmetric risk reward. And we're doing it based on real world insights, you know, reacting to not just we see it in a macroeconomic environment, but, local inputs. It's not just charts or formulas or sentiment. It's very strategic positioning where we understand valuation gaps. We can see when in a sector that we think is great and doing well, a stock is trading below NAV or below peer comps. And then you've got to ask the questions why and understand if there's a chance there for a re-rate. We can build themes around understanding where a region is in a virtuous cycle. Let's say a company has a great discovery that's absolutely world class in an emerging area. That attracts additional capital into the area as people go looking for more of that style of deposit. More dollars spent means a greater likelihood of more discoveries, which just keeps that snowballing along. Being able to identify that early can be a huge advantage. Understanding where projects are in their life cycle and the different catalysts that are coming, permitting milestones, drill results, resource updates. The cumulative effect of all of these things, I believe, lets you construct portfolios with a superior risk reward balance than some passive index. Now, obviously, a lot comes down to the individual managers to treat that the right way. But you touch on an interesting thing because the return for metals markets is very pronounced. The dispersion that you have around an average return for a market is not a normal distribution. It's not like you have an average and then an even sort of set of results each side. In metals markets, just like in ore bodies, you have a lot of average companies and then you have a long positive tail where a small number of companies actually end up delivering most of the value. And these things end up getting modeled by log normal distributions or power laws or other, fancy statistical terms. But at the end of the day, you could look at something like 2024 when the broader market actually had a poor year. It was a negative year. But the top quartile of results returned close to 200%. And that was a low dispersion year. So this is arguably one of the strengths of well-run active management. If you've got a team who can identify which sectors of an environment are working and lean into those and reduce your exposure to areas where there's challenges. You can adapt to a changing environment. You can adapt to technological breakthroughs, changes in legislation. All of these can impact performance.
When you talk about looking at different names and different market caps and so forth. How do you look at day in, day out operations? Are you sitting behind a computer screen just doing analytical work and looking at balance sheets? Are you getting on the airplanes and going out to these sites? Are you doing a combination of it? Like, what makes kind of your approach maybe unique to kind of a core way to get exposure to the space? Talk about that a little bit. Give us kind of what a snapshot of a year might look like for you.
You touched on it before. I'm a little different to most PMs in that I'm an economic geologist, but more than that, I spent 20 years as, I guess you'd call me, an industry veteran now. So this is before joining Sprott. And I was doing many of the things that many of the companies we invest in are trying to achieve: make discoveries, develop them along, become successful, profitable operating mines. And that gives us a unique insight. And we look at this stuff every day. We look at what's changing at a company level, at an industry level, all the way down to a project level. I would say it boils down to this. What you're asking is, what's our edge? And the combination of specialist technical knowledge and deep industry experience, if you leverage it correctly, can really help. It lets you avoid overhyped plays and focus on assets that have real upside. It lets you time your entry and exit points into investments with a lot more nuance. I'll give you some examples. You know, when it comes to leveraging your technical insights, understanding ore body quality, understanding, the relationships between the grade and the tonnage and the metallurgy. Arguably, with a technical background, we can maybe get there a little quicker than most and maybe ask questions a little more nuanced than a retail or generalist investor might be able to do. We understand which deposits are going to be feasible, not just in bull markets, but through an entire life cycle or price cycle. Jurisdictional risk, technical risk. We understand when projects get renamed and rebranded and brought to market that perhaps others who haven't been doing it for this long might not immediately latch onto. We get to see a lot of deal flow that smaller or non-specialist investors might not see. We get to see corporate strategy. A lot of these companies, when their boards are seeking feedback on what they're doing, will reach out proactively to us and ask to set up time for a conversation. So there's an opportunity there to not just follow corporate strategy, but have a voice in it. Not the only voice, but increasingly we're seeing more and more engagement from boards seeking feedback on how they should be thinking about metals markets. At the end of the day, there's a pattern recognition thing there as well. We've studied what made outperformers succeed. We look for teams that are serially successful, whether it's great geology, great management, great timing, well run companies with stable balance sheets. These are things which, in the right circumstances, again, to lean on a phrase earlier, there's a handful of companies that will deliver outsized value. And the sooner you can identify those, the better it's going to be for all involved, I suspect.
And I want to get to different metals in a moment as far as which ones you like, which ones look interesting, and so forth. But before we do that, I would imagine in mining, when something looks great and is great, and you visited it and everything, and then all of a sudden something out of left field happens. What do you do when that happens? How do you handle that from an active standpoint?
Great question. And what you're describing is our job, which is how fast are you able to find a fatal flaw with a new project? Or in the event something structural changes with your investment thesis, how fast should your investment change? And the answer is it depends. There's a lot of nuance, and you never hope for it, but let's say an unplanned rock movement in a pit, which can delay mining, impact cash flows in the short term, but maybe it's not a fatal flaw and it's able to be rehabilitated, and the ounces you were hoping for just get delayed. And if the stock were to sell off disproportionately on that news, it can create opportunities. Then there's moments where it's genuinely time to go, oh my gosh, something has fundamentally changed. Our reason for owning this stock has gone away, and perhaps so should we. That's something as active managers you're able to deal with very quickly to put a tourniquet on something and stem some of that bleeding. But the inverse is also true. We're in a position to react very quickly, perhaps more quickly than other investors because of our insights, to new discoveries, to something that fundamentally changes for the better at a given company. Certainly, for some people, they'll have restrictions on what they're able to invest in, either because of a market cap threshold or a necessity to be a producer or some other restriction that won't apply to active managers per se, depending on their mandate, meaning we can be early on great ideas.
Well, and speaking of ideas, I know you predominantly focus on the miners themselves, taking a position, an equity position. And I guess recyclers probably fall into that as well. I'm sure there's equities that are recyclers and that kind of thing. What else would you find in an active portfolio? Are there other kind of vehicles or paths you can go down to gain additional exposure?
There's a whole ecosystem out there of opportunities. It's worth saying at the outset, the way I think of it is some of those niches of our industry are wonderful things to have exposure to, but it's always going to be a very calculated, bespoke process when we take positions in some of that. And it will always be the tail and not the dog, if, mixing that metaphor makes sense.
Mm-hmm.
One of the areas would be streaming and royalty companies. They've been tremendous value creators in recent decades. They've been able to provide creative funding solutions to miners at lower costs of capital than those guys would have been able to source anywhere else. The royalty and streaming companies can be inured to many of the operating risks while still retaining upside to commodity price improvements, to exploration success. So at different times in the market, they can be very good investments. Then there's picks and shovels service providers who support the miners in a variety of capacities, whether you're a drilling company or a laboratory or something else. And they've got capacity to scale up very quickly, and they can benefit, you know, across multiple commodities at multiple times. I think it's worth noting the best service providers, if you get the right ones, come with the potential to improve the industries they work in.
Mm.
The way that laboratories have been able to push down detection limits for different metals has absolutely led to new discoveries. And improved technology means improved separation of ore and waste. And I've worked with these guys for years. They're businesses that we understand, and when they're well run, they can be great value creators.
Well, and let's stay on that then. Talking about different sectors or different metals, as it were. What do you like right now, and maybe what's kind of up and coming that is interesting, but maybe not just yet? So, what are some of the spaces or metals that really have your attention right now?
So we touched on a couple of them earlier in broad strokes. When you talk about energy growth, energy addition, when you talk about the requirements for, you know, big infrastructure build out and power needs, things like copper screen very, very well. You know, the rate of growth for copper is tremendously bullish in the medium to long term, not just from a demand side, but I can tell you that all of the things we talked about, whether it's AI data centers coming up or the idea that electricity growth globally is set to really start to inflect, it doesn't happen without copper. But it doesn't happen without uranium as well. Nuclear power is seeing a renaissance like I don't remember in my career, but the idea that all of the big energy firms are trying to build AI data centers, technology centers, and we see them, they know they need independent power sources that won't compete with other people. They know it needs to be cost effective and they know it needs to be clean. And right now that's nuclear. And that's happening, everywhere you look. Elsewhere, I would point out that a very interesting sector occurs inside something that doesn't spring to most people's thoughts when we talk about this, but steel is essential for supplying the world with energy. It's an infrastructure enabler, is the phrase that I've latched onto. But whether it's hydropower, whether it's solar power, whether it's electric vehicles, none of it happens without steel. But steel's got a couple problems, not least of which, questions around global economies, tariffs, and other big headlines. But it accounts for something close to 10% of the world's carbon emissions. And that's more than all the cars and planes put together. But there's a small subsector in there called green steel, which is able to be fed from recycled products and high DRI, direct reduced iron feedstocks. And it uses an electric arc furnace rather than a blast furnace. And it has orders of magnitude lower emissions. And it's revolutionizing the industry because where you do it right with access to recycled products and cheap power, it can be very cost effective. It's got big regulatory tailwinds, and it's a tiny proportion of the global market. But we see it growing at a compound annual growth rate over the next 5 years of more than 20%. So within the behemoth that is the industry, this is revolutionizing it, and it's going to drag the whole industry into a better place over time. And the early adopters here, the most well run companies, they're going to have the best sites with the best access to scrap and the lowest power costs, and they're going to be the beneficiaries.
What do you think about silver? Do you see silver becoming more of a critical material and really falling in that category of just another metal, or is it still kind of living in the precious metal category?
Silver's critical now, and it does tend to move with gold on occasion, but there's whole periods in the market where it will correlate better with copper than it will with gold. You'll have that relationship break down. It'll follow copper for periods. Silver demand right now is pushing 60% of industrial applications. If you go back just a few years, it was nowhere near that high. The introduction of it into solar panels, into electronics, into batteries, that's where the growth has been and where we see it continuing. The silver market has been in deficit since 2020. I don't see that changing anytime soon. All of the world's supply right now can basically be consumed by industrial applications, depending on how you want to slice the numbers. It's got strong roots into the electrical economy. It's increasingly seeing a range of new use characteristics that just didn't exist, and we're finding more and more for them. And thrifting will get better. You'll see some substitution. It will come and it will go, but silver's been one of the rising stars here with a strong cargo the last few years, strong demand. And if that starts to shift, we'll adjust accordingly. But it's pretty exciting right now.
And I hate to be self promotional here because you and I both work at Sprott, but I think it's worth asking this question anyway. So you're riding down the elevator with a client, you're talking to them about the metals markets. Why Sprott? Why what you do, your team does. Why talk to us? Why invest with us? What are we bringing to the table?
For the last several decades, Sprott has been not just a leader in the space, but they've been a thought leader. I've learned so much in my time here from so many people who are so skilled in different parts of our business. And the capabilities we have from looking at projects as equity investments, as lending projects, there's royalty and streaming. I don't think there's many groups that can replicate the breadth of that. The deep in-house technical expertise that we have. The team that I work with has people who are just wizards at financial analysis that understand corners of markets way deeper than most people would be willing to go. The collaboration that comes with that is a testament to the company, but it helps make us all better. I was very excited to join Sprott 7 or 8 years ago, and I'm proud to be here now.
So if you're an investor, you're looking to allocate capital to this space, what would you say to somebody relatively new to the space or someone that's maybe re-entering the space for the first time in the last decade? What would you leave them with as far as why invest in the space now? I'm not talking specifically about Sprott, but just why would you allocate capital to this space right now?
We've touched on facets of it during this talk, but the drivers that I talked about, whether it's energy growth, mineral security, and the idea that governments have hit a tipping point where they understand now that we're in a multipolar world. You can't rely on the rest of the world to help you along. Security of supply is power. And if you don't have your minerals or you don't have access to them through friends and alliances, you're sticking out like a sore thumb and you're exposed. So you're about to see a whole bunch of elements which weren't in people's vernacular suddenly get very, very topical. Uh, Rare earth elements are a recent one which has been in the news recently. The rise of energy, the mineral security, and the ongoing energy or the rise of non-traditional energy sources, solar, hydro, nuclear. We've kind of reached that Malcolm Gladwell-like tipping point where it's in the public consciousness. It's happening.
Mm-hmm.
The investment is starting to snowball. It's rolling down the hill right now and gathering momentum faster and faster. I'm incredibly bullish on the medium-term outlook here, looking through the short-term perturbations we're working through. And I think it's a wonderful time to start having that discussion.
All right. Well, Justin, once again, it's always a treat to talk to you. Thank you for your insight. I look forward to seeing how things develop as we go down this active journey within the metals market. So, as always, thank you for your time today and your insight.
My pleasure, Ed.
Well, once again, you're listening to Sprott Radio, and I'm your host, Ed Coyne. Thank you for listening.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.